How relevant is Italy's political situation to the U.S. financial markets?
That's really a tough question to answer in a strange way. We saw on Tuesday, as we returned from a long weekend in the U.S., the markets basically show a real flight to quality trade. The equity markets got hammered to varying degrees. The bond markets, the treasury bond markets, rallied strongly, as did the dollar. So why did this all happen? The proximate excuse is that developments in Italian politics worried European investors about whether Europe was looking at potentially another shock to the euro. There's been a populist government elected in Italy. Remember that Italy has had basically, on average, one government per year, if not slightly more. But the latest populist government in Italy is scaring people as to whether Italy has designs on potentially leaving the Eurozone or leaving the euro currency mechanism. It's all fairly vague. But for whatever reason, despite weeks of Italian bonds selling off and Italian banks selling off along with them, the selling seemed to come to a head during U.S. hours as we returned from the three-day weekend. Perhaps that was because we didn't have an extra day to adjust, perhaps not. But what you saw was some real, what I would call get-me-out kind of trading. And I think that really started in the treasuries and in the U.S. treasuries and in the dollar, because what you saw was the dollar strengthened at the same time that interest rates were coming in, which is a bit of an unusual reaction unless there's a flight to safety trade. Remember, all things being equal, a higher yielding currency, as long as they can pay their debts, is more likely to appreciate vis-a-vis a lower yielding currency. But the move, let's say in the 10-year, was staggering. I think that was exacerbated by some heavy shorting in the Treasury bond complex that we'd seen coming to a head there. So there's a lot of little specific effects, and let's try to walk through some of them. I alluded to the Treasury bonds. It's been a very popular trade to short the 10-year. Why? Because the Fed is certainly in the tightening cycle. We're seeing signs of inflation on the horizon. All that would bode toward higher yields, lower prices on 10-year treasuries. The problem is there's a lot of people betting on that, so you had a huge short interest in that regard, whether expressed through the speculative futures positioning, or outright people shorting, which is a little harder to measure. But there was a big short interest in the 10-year treasuries. That's the sort of thing that one person's safety is another person's fear. So if you're the person short the treasuries, you've got to race in there and cover. Otherwise, you're looking at a potentially big hit. So I think that worsened the move or improved the move, depending on your point of view. Again, the flight to safety moved into the dollar. Well, the dollar had been appreciating versus the euro for a while, and I think you probably triggered some stops as we traded through that yesterday. The equity markets had been meandering along, sort of looking for a catalyst, bumping up and down against some trend lines, and yesterday was sort of a trigger event where, okay, let's sell a little bit, and the selling just continued until we hit some support levels in the afternoon and found a bottom, and then rallied slightly into the close. Rally is a strong word, but to describe what happened, but bounced a little bit into the close. So fast forward a day. We wake up Wednesday and realize Europe isn't coming apart, at least not today. A lot of these moves seem to be overdone. And now let's take a look as of where we stood, let's say noon on Wednesday. By that point, the S&P had more or less recouped the levels that had closed on Friday. The Treasury bonds had reversed some of the move that they'd seen the day before, though not all. And one interesting trade to me was VIX. The volatility index rallied about 5 points yesterday, and as of about noon today, Wednesday, it had made back, let's say, 2/3 of that, maybe 50 to 60% of that, given back 60% of that. So we went, let's say, from 13 to 18 to 15, using some real rounding. One thing that I'd like to point out here, I'd seen some evidence of people of money flowing into the TVIX and some other short volatility contracts. If you're watching this and you're doing this, let me remind you of a phrase: fool me once, shame on you; fool me twice, shame on me. If you are shorting volatility when it gets down to about 13, or maintaining your short when the VIX gets down to about 13, what are you trying to achieve? The VIX really is structurally, it's very difficult for it to get below 9, 8. So you're trying to play maybe a 5-point move. You lost 5 points yesterday in about 3 hours. It's a very skewed trade, skewed against somebody shorting volatility. It's the kind of trade that should really only be done either on spread or by professionals. But if you're doing this through these levered VIX short ETFs, it's a sucker's game. Understand that, and really that's something to be avoided. Sorry to get a little preachy on you there, but to the short answer of the question, you never really quite know what's going to affect the U.S. markets. I had a long discussion with a friend of mine who's a former portfolio manager, and his feeling was that what we are going to see over the course of the tightening cycle as we unwind unprecedented quantitative easing is you're going to see some sequential shocks. The first one was the volatility shock, let's say, of February. I think we're in the midst of the second shock, which is emerging markets having some turmoil, and by that I include things like Argentina, and to the extent Italy is more developed than that. But Argentina and Turkey fall under the emerging markets criteria, and Italy has always been sort of a peripheral market despite its economic prominence. But that's been the latest shock, and the reason the shocks get worse when the central banks are not pumping liquidity in is because when the world is awash in liquidity, we tend to see that there's just money to be made by buying dips, and people do it. When there's less liquidity flowing in, buying the dip becomes a riskier proposition, and excesses, which develop all the time in normal markets, they overshoot in one direction or another, but excesses tend to unwind themselves in a little bit nastier fashion. And if you're an equity investor, what that probably means is equities, because of buybacks and the economic focus that we're seeing, equities probably the last shoe to drop if we start to see shoes dropping. But expect to see some of the weak sisters of the financial markets see periodic shocks, and I think this is going to be not a bug, but a feature as we go forward into a tightening cycle from the world central banks.